The best retirement plans for self-employed individuals. If you own a business or earn any 1099 income, even if it is just income from a side hustle, then listen up because I'm about to walk you through the best retirement plans available right now. Some of these accounts will literally allow you to contribute 3 times more to your retirement and save 3 times more in taxes than typical retirement accounts available to employees at their job. And for those who hate being confined by contribution limits, don't worry. There are other options available that allow you to defer as much of your income as you want. There are so many options available when it comes to retirement, like traditional 401ks, solo 401ks, SEP IRAs, cash balance accounts, and so much more. And the best option will be based on your unique set of circumstances, such as the number of employees you have, the amount of income you wish to defer, and so much more. But don't worry, if you stick around for this full episode, you will leave this video knowing the best option available to you. If you're new here, my name is Sherman the CPA, and I tax plan every single day for high income business owners over at mycpacoach.com. I share my real world experience here on YouTube, and if you want to learn more ways to reduce your taxes, be sure to subscribe to our channel. A lot of my clients have excess income available near the end of the tax year, or in other words, they have income that they don't want to pay taxes on, which naturally leads us to looking at various tax shelters to shift that income into, which lowers the income they report on their tax return and therefore reduces their taxes. And self-employed retirement plans are one of the most popular and easiest tax strategies for me to implement. You can literally get a tax deduction from transferring money from your personal bank account into a retirement account and get massive tax benefits. But the trick is picking the right or the best retirement plan. If you pick the wrong one, your contributions can be severely limited, and even worse, it can provide zero tax benefit. And trust me, you don't want to be that person at tax time who just realized the $20,000 they put into their Roth IRA did not save them any money in income taxes at all. So to avoid that, let's carefully walk through your options and help you pick the best account available. All right, so let's start with the easiest retirement account to understand to set the stage here. Traditional IRAs, which simply stands for individual retirement accounts. Now, anyone, literally anyone, can set up an individual retirement account, regardless of if you are self-employed or not. You can set up a traditional IRA and contribute up to $6,500 per year or $7,500 if you're over the age of 50. And when you contribute this amount, you would get a tax deduction in the year you made the contribution. Then you could invest the money inside of the account for years and would only pay tax when you start withdrawing the money once you turn 59 and a half or at a later date. Now, one major advantage of traditional IRAs is that you can contribute to this and other retirement accounts like 401ks, for example. So oftentimes, if you're looking to contribute more than what your 401k plan allows you to do, this can be a great option. Now, another major benefit is that they are inexpensive to set up and can be set up at almost any bank or financial institution. Now, there are 2 big cons about traditional IRAs. Number one, it's a very small contribution limit. When you are earning a lot of income, a $6,500 tax deduction is not life-changing, but can be a nice boost. And number 2, income limitations. If you are covered by a retirement plan at your job, there may be income limitations that limit or completely void this deduction altogether. And it may not even be you who is covered by a plan at your job or business, but if your spouse is, your deduction may also be limited. Nonetheless, this is one of the simplest examples of a retirement plan that anyone can set up. Now let's go up a notch here and talk about traditional 401k plans. Now 401ks and IRAs are highly similar, but the main difference is that a 401k is an employer-sponsored retirement plan, whereas an IRA is something that does not have to be set up through an employer. This is what most employees are accustomed to at W-2 jobs, and if your business has employees, this may also be a great option for you. As a self-employed individual, you are considered both an employee and the employer in your business. This means that you get to benefit from both the employee contribution limit and the employer's contribution limit in a traditional 401k plan. Now, this is very important because this gets even better when we talk about the next option here, so just keep that point in mind. Now, for traditional 401ks, the IRS allows employees to contribute up to $22,500 of their own income into a 401k account as of 2023, which is 3 times more than a traditional IRA. Then the employer can contribute to the retirement plan as well, which normally ranges from 3 to 5% of the employee's annual compensation, although it may be much higher or lower. In fact, you can even do a 0% employer match, which allows your employees, including yourself, to take advantage of the employer contribution limit without necessarily increasing your business expenses. And since you're self-employed, remember, you can still take advantage of the employee contribution limit and get up to a $22,500 tax deduction for contributing to your own retirement. And to set this up, you can use a low-cost 401k vendor to administer every part of the plan, which I'll link in the description of this video. And if you're worried about the cost, don't. The IRS has a great tax credit that can cover most of the setup costs for you, but it's important to get a tax professional involved who can guide you through these types of things. Anyway, traditional 401ks are great if you have employees, and if you don't have any employees, it actually would not be my first option. So let's talk about the best retirement plan for self-employed individuals who do not have employees. Solo 401k plans. A solo 401k is a one participant 401k plan that allows you to contribute up to $66,000 as of 2023. Yes, you heard that correctly. You could get a $66,000 tax deduction, which is almost 3 times greater than the traditional 401k individual deduction and 10 times the individual IRA deduction limit. And by the way, if you associate your spouse with the business, your spouse could also contribute up to $66,000 to this account as well, allowing you to contribute up to $132,000 to your retirement. And by the way, this contribution limit typically grows each year, which means even more tax benefits are on the way. So what's the deal with this and why can you contribute so much? Well, remember, as a self-employed individual, you get to benefit from the employee contribution limit and the employer contribution limit. Now, remember, I told you earlier that typical employer contributions are 3 to 5% of the employee's compensation. But since you are the only employee, you can use a much higher contribution limit for yourself. So here is how these solo 401k contributions work for self-employed individuals. As an employee, you can contribute up to $22,500 as of 2023, which is the same thing as the traditional 401k limit. But then as an employer, you can contribute another 25% of your income from the business up to the contribution limit of $66,000 as of 2023. For example, if your business earned $175,000 in net income, you could contribute $43,750 as an employer and $22,500 as an employee, which would allow you to contribute a total of $66,000. However, if your business income was only $100,000, then your employer contribution would be limited to $25,000, which would only allow you to contribute a total of $47,500. So your contribution will be a little bit lower, but still a much higher contribution than most other retirement options. Now, a popular alternative to solo 401k plans are SEP IRAs. A lot of my self-employed clients use these accounts because they are very easy to set up and have the same $66,000 contribution limit as solo 401ks and allow you to contribute up to 25% of your income into it as well. However, there is one characteristic that I do not like, and that is the fact that there is no employee contribution. which makes it much more difficult to reach the $66,000 contribution limit. So instead of being able to make the maximum contribution of $66,000 with $175,000 in income, like we did with the solo 401k example, you would have to earn $264,000 in income with a SEP IRA to make the same contribution. That's a $90,000 income difference just to receive the same retirement and tax benefit, which is why I typically prefer solo 401ks over SEP IRAs. So in summary, if you don't have any employees, I suggest a solo 401k. If you do have employees, then I would typically suggest a traditional 401k. But what if you want to go above and beyond all of the contribution limitations we've covered so far? What if I told you there was a way to defer anywhere from $100,000 to $300,000 of your taxable income from your taxes? Well, you can with something called a cash balance plan. A cash balance plan allows you to set aside a percentage of your income for retirement and receive a tax deduction for doing so. The exact amount you can contribute to a cash balance plan depends on your age and your income. The older you are, the more of your income you can contribute to it. All you or an employee would have to do to qualify is to meet a vesting period, which has to be at least 3 years, and upon meeting it, you or the employee will have the right to a percentage of the agreed upon amount upon retirement or when they end service at your firm. Now, in all transparency, there are several ways to design a cash balance plan, as well as rules, requirements, administrative costs, and so on, which are things that a great CPA can guide you through. But as it relates to shifting income off of your tax return, deferring taxes to the future, and building wealth for retirement, it can be a great tool. If you found this video helpful, please help me out over here by clicking the like button below, and be sure to subscribe for more videos like this that can help you reduce your taxes. And if you want a comprehensive tax plan that is tailored specifically to your needs and is guaranteed to reduce your taxes by at least $10,000, apply to become an exclusive client of mine today at mycpacoach.com. Thank you for watching, and I'll see you in the next episode.